The probability of a double-digit year, we think, is the highest since 2009.
And the answer is no, we're not. There's a lot further we're going to go down.
We're in a bear market. It's 100%.
Welcome back, passive income investors. Today I want to talk about the tale of two markets, so let's jump right into it, guys. So recently, like the beginning of my video, if you watch a lot of investors like I do, you're really going to get this bull-bear case going on where we're really not sure if the market is in this bear territory for the next 2 years where we're going to see it hit new lows month after month, or if we were just in a correction and we're going to see this upside coming into 2019, toward the end of 2019, or even in the summer of 2019, guys, where everything's going to explode and we're going to see a market come back. But depending on who you listen to, you're going to hear two sides to this. Now, because a lot of people look into the past and they want to look at what past performance does, you got to understand that doesn't really correlate into the future. But we've typically had a bear crash or a market correction every, what do they say, 8 to 10 years, and we're currently in the longest bull run in history, guys. So we've also broken the trend there, and we've seen a mild dip, which is what I would call the correction, but a lot of people think it's the starting of the bear market, guys. So we should be shivering, running, being horribly afraid and shorting the market, or should we, guys? Was this the bottom of the correction and now we're seeing a rally back, so maybe we should be buying into it to collect the new highs? This can get very confusing, especially if you are a beginning investor, guys. But from my own personal perspective, I buy when they're up and I buy when they're down. I especially like to buy when they're down. That's when you really want to be leveraging in. I just sold $15,000 worth of gold to buy into the markets, guys, which you can go watch the very first video on this channel. You can see me actually sell that gold and how I sold it to buy stocks, because when I saw this correction come, guys, and as a personal investor, when I look at starting yields, especially on bank stocks, or if you are a dividend passive income investor like myself, you're really going to want to be buying into these bank stocks right now because their starting yields are exceptionally high, like 2017 level high, guys, which is really awesome because you can get like something like Bank of Nova Scotia or Canadian Imperial Bank starting at almost a 5% yield, and same with like Bank of America in the US, guys. They're paying a really high 2% yields. So when I look at that, guys, it's kind of this battle of two stories, because a lot of people look at the indice as a whole, and I think the indice as a whole hasn't come down enough to be in full correction territory. And it's a hard thing to debate, guys, because if you look at the tech sector and the FANG stocks like Facebook, Apple, Google, all of those guys, they have come down substantially, like 30% plus, and they're the reason the whole market has come down. And their PE ratios are trading price to earnings. If you don't know what price to earnings are, it's the metric that kind of tells you what a company's trading at. And when you have a company like Apple trading at a PE of 12 to 13, your jaw kind of hits the floor when you compare it to a company like, say, Coca-Cola that is trading at like a 40 plus PE, or Procter & Gamble. These are like the staples to society. They're not high growth companies at all by any means. Like they don't have double digit revenue growth like Apple or Facebook does, but at the same time they're trading at a multiple that is 4-5 times what they're trading at, which is absolutely absurd in my opinion. So for us to fully realize this market crash into the bear market, guys, I think we need to see the staples come down and see those stocks come into a fair value territory, but they're not, which leads this twisting of confusion of what to buy. Now, if you are into index buying like ETFs, might not be the best idea, guys. If you're into ETFs and you're buying ETFs, this is where you might see the stronghold struggle, because you had the growth stocks come all the way down. If the rest of the stocks come with it, your ETFs are going to get hit really hard. Whereas if you own individual stocks, I think this is a beautiful time to be leveraging into Apple, Facebook, and all of those companies. If you don't already hold them in your portfolio, it already makes up about 30% of my portfolio just between Apple, Facebook, Tesla, and Microsoft. Those are my 4 tech picks. I got in them at a really good price, and I just started buying some more of them, guys, at these ridiculously low levels. But honestly, in a market like this, who are you best off to be? Because long-term investing in these bear markets isn't going to make you the most money. So if you have long-term investments on top of that, guys, you can also do some swing trading or day trading. I'm not a fan by any means of day trading, but that doesn't mean you can't make money at it, guys. It's just a much higher, riskier thing to do that 90% of people fail at. But swing trading, on the other hand, I think more people succeed at, and it's much easier, especially if you're playing companies like gold stocks. Like I think there's BTO, there's a few gold stocks, and you'll notice they don't go up a lot. They don't go down a lot. They kind of trade this 30% range, 30 to 50% area. And you could probably buy into one of these companies, hold on to it for 3 to 6 months, or short it for 3 to 6 months and collect one of those upswings and downswings. If you do this with ETFs, you can find, you're going to have to do your own research, guys. If you can find an index fund of really good companies that have rather volatile but stable yields and things like that, you could try and do that. That'd be a good way to play the volatility in this ridiculous market. But to sum things up, guys, as a passive dividend investor, I honestly bring on the bear market. It's an ego check when you see your accounts drop quite substantially. My overall portfolio, I think, has dropped maybe 10-15% at the max at its peak bottom, but it's had a nice little comeback as well. And my overall portfolio has seen a 60% return. So for it to drop 10-20% isn't the biggest deal for me, because I've played some higher risk companies and I've had good growth over time. But again, it might be different for you guys, but honestly, I'm just looking for dividends. So if I get the starting yields I'm getting, keep bringing them down, because I want to buy the next 2 years, and hopefully we stay in this corrective mode for the next 2 years. Again, it might be a different story for you. Let me know in the comment section below, guys. But stay cool. I hope you enjoyed this quick rant. Stay awesome, and I will see you